Aditya Narain. Good morning. Thank you so much for joining us here in the market. There's so much to talk about, whether it's an earnings season that has just ended, the next triggers. Let's first begin with the big news over the weekend, which is of the farm laws being repealed. In your assessment, what can this mean for the markets, the market impact? Many believe that this is the largest signal for the markets, with Uttar Pradesh and Punjab going in for election. Will reforms take a backseat? It's back to vote bank politics and reforms and economics.
Firstly, a very good morning, and thank you for having me on the show. In terms of the farm law repeal, there are, I think, two elements to it. One is, does it make a difference to the underlying businesses and trends? To some extent, it doesn't, because the gains were also expected to be much longer term. But the second bit is whether directionally it's a little bit of a challenge, in that you were getting a lot of tailwind in terms of reform, in terms of disinvestment, in terms of privatization. To some extent, I think this does hold things back a little bit. But quite honestly, I think a lot of focus and a lot of energies are really focused at this point in time in terms of the economic revival that is fundamentally coming through, the earnings trajectory that a lot of people are following, including the results just gone by. So to that extent, I think it's a reality check to some extent, but I don't see it having a meaningful impact as far as the market is concerned.
Okay, because India has been outperforming the rest of the world, and that was a larger question that, is this a one case of one step forward but two steps back? Aditya, the other big story that we, the handover we got from last week for the primary markets with what's happening to Paytm. The tech IPOs was super hot. We will have a next wave early in 2022 from a delivery, Farm Easy, Oyo, Ola, all of that is expected. The Paytm listing, the impact is going to have on the primary markets?
I think this listing is more of a reality check for the markets than the farm law. Let me just put it that way. It's not about losing money on one IPO. It's about the fact that it had become a one-way street, a very aggressive investing that was happening, with valuations across the board which had tended to be a little bit more debatable. So I think at some level, there are going to be losers on the back of this. But I think at a broader level, I think it's actually a good thing that has happened at the market level, because it brings in some level of rationality, some level of sanity, and just a much greater scrutiny of what's coming to the market. Is this something that is going to puncture the IPO cycle and the way it was unfolding? I quite honestly don't believe so. Is it going to make it a little bit more rational? Could it make it a little slower? And a little bit easier in terms of valuations? I think yes. So to some extent, a little bit of a reality check, some losses, but I don't see it changing the trajectory very fundamentally. I do believe what it will do is it will push the focus a lot to business models. Remember, with this company, the challenge really has been that valuations have been high, which has been true for a lot of such IPOs. But the business model hasn't been as clear as for some of the other companies. So I think what you will get is some sanity in terms of valuations, but much greater scrutiny in terms of business models going forward.
Right, okay. Paytm, by the way, has fallen 32% from its listing day, and the stock is sharply in the red today, to another 7% gone for Paytm. Okay, that said, Aditya, we've time and again spoken about real estate and as to how you as well are bullish. That's where all the traction is. That's the hot market, and volumes as well are kicking in. Well, would you say that easy gains are behind us within realty, or would you say that the cycle is just about started?
I'd say at a stock level, the quickest and the easy gains are at many levels behind us. Stocks have moved from trading at an average of a 30 to 40% discount to NAVs to anywhere between 0 to a 30% premium to NAVs, on NAVs that have actually been pushed up slightly from a price perspective, but much greater from a volume perspective. So I'd say the easy pickings at some level from a stock perspective have probably been made. In terms of, I think an equally big question, if not the bigger question, is whether the underlying cycle is something that has only started out and that can go on a long, long way. I think that is a reasonable expectation to make at this point in time, that you are going to see a much more, a stronger cycle and a longer cycle. I don't see it accelerating from what has happened in the very recent past. So if you were to step back and see what's happened with property bookings at the middle to higher end in the metros, those have just skyrocketed. You've come back to the times of people queuing up for seeking allotments. I think that, I think that is going to ease off. But I would believe that you will have a cycle that will start broadening a little bit. Do remember, it's quite narrow at this point in time. So it will broaden a little bit. It will stretch for a reasonable length of time, but the pace will tend to ease off. And you might start seeing some support coming in through from prices. So I'd say I'd be more comfortable or more bullish on the underlying cycle than I would necessarily be in terms of stocks, because there, as you said, the easy pickings have probably already been made.
Could the same be said, Aditya, about IT as well? Because while realty may have just about started its move about a few months back, IT has had a long time under the sun. And this amidst growing concerns of wage inflation, although growth as well is there. But again, would you say that the best is behind us in terms of stock performance, or do you think IT makes a case for long-term re-rating as well, which could push the stocks higher?
So I think I would be, if I were to really compare them, I'd probably be more bullish on IT than I would be on real estate, to put it very simplistically. Because I think there are a couple of elements as far as the demand cycle is concerned. The first is that it is global. The second is it is broad-based. And the third is that India is particularly well positioned as far as this space is concerned. And I would tend to argue that when the underlying demand cycle is very strong, it's going to be less vulnerable to what happens on global macro. I think you do need to back it, and you will likely see reasonably decent returns for a sustained period of time. Now, I think, is there an element of cost pressure that are accelerating? Quite clearly so. Are those cost pressures as exaggerated as you see some of the headlines? We would tend to believe not. We also tend to believe that that's a space where supply can come in, particularly from an India company perspective. Supply can come in relatively faster than what people will tend to anticipate. So what you will theoretically end up with is that top lines continue to look good, well in line with what people are forecasting and possibly beating them a little bit. Margins for the next 1 or 2 quarters could be a little disappointing. And so to some extent, you might see a staggering in terms of stock performances. But I do think that if there is a cycle and if there is a trend and if there is a sector to back for a 3, 4, 5 year period, I would argue it is the IT space. And I think, as I said initially, I think the difference really is real estate and a lot of other sectors are being seen in a local context and vulnerable to what happens with global macro and interest rates. I think that does not hold for IT. It is global, it is very hedged, and you're going to get demand from all ends. So very positive in the space, even though the near term might be a little lackluster.
Okay, so IT still being numero uno, a preferred sector. But are there, you say the sectors to avoid are FMCG and auto. Let's begin with auto first. Have you changed that view at all, given what all has been happening? Whether, look at Tata Motors, recently the big move on escorts and the Japanese partner increasing stake, automakers looking to get more EV ready.
So, on a stock specific basis, we continue to be quite positive on a couple of stocks. Tata Motors, in fact, is part of our Braveheart series, and it's been for a while, right? We also think this shift towards EVs is only going to accelerate. It is a fundamental shift, and like you've seen globally, a lot of value is going to start shifting onto that side, right? That said, do remember these are big sectors as they exist. And at the end of the day, they are very demand sensitive, and that's what drives them. Just as I argued for IT, the demand outlook is very good, or for real estate, if the demand outlook is good, you're sitting in a safe space. I think as far as the auto side is concerned, because there is a high element of discretionary spend, because the jury is still out in terms of how much the economy has rebounded. I think that's what you've got to watch more closely. And if you were to see the Diwali season that has gone by, demand has been relatively lackluster. And so to that extent, I think it's still a little early from our perspective to start making an aggressive auto call at this point in time, because demand is going to be a little overriding. So you will have stock specific stories, but at a broader level, at a sectoral level, we just wait out a little bit more to see a jump back in demand.
And FMCG, is it the sector to watch out for, not and avoid, not because of lack of demand, but because of the recent valuation run up?
Sorry, I missed which sector were you talking about? I missed that.
FMCG. Is that the sector to avoid
FMCG?
primarily because of the valuation run up and inflation being transitionary?
Yes, it's largely because valuations are high. So to that extent, we are just a little cautious in terms of how much return you can make off this sector, particularly because, if you look around, there was a point in time where earnings were very, very slack in the market, in the broader economy. And there you got a modicum of stability and consistency as far as earnings were concerned. When you have a rebounding economy like you do have in some segments in any case, then the market is going to start paying up more for sectors that show large earnings growth, or at least where you can expect, step up functions at some point in time. I think that is unlikely to happen with FMCGs, while a lot of the margin pressure has probably been taken and is probably peaked because of costs. I'm not so sure that costs are going to drop off dramatically enough for the earnings trajectory to start changing very dramatically over the near to medium term. And so in that context, they're a safe haven if you're very bearish on the market. But from an earnings profile, from a growth profile, I think it's just going to be a little bit more muted. So from a portfolio perspective, we would tend to be a little underweight there. We just think that there are other sectors where there's either a catch up to play from a pure valuation perspective, or there is a robust demand cycle which allows you to piggyback that.
Aditya, you're a keen observer of the entire financial universe and banks in particular. Irrespective of consumer lending actually picking up and the emergence and evolution of banks and financials to become fintech companies now, what explains the underperformance of banks at large? And on the other hand, would you say that this underperformance is actually a good opportunity to try and add to your portfolio?
So two things. I'll answer your second question first. I do think it is an opportunity to actually pile into this sector. We're running it as a large overweight, and it's about time it started working. To your primary point, which is a bigger one, which is what explains this underperformance. It's a little bit of a challenge. Firstly, you're seeing this globally, right? Secondly, you actually already started seeing loan growth pick up, a fraction. So to that extent, it should have started coming through. So I would just attribute it to the fact that at this point in time, the market seems to be interpreted, seeing this as a phase where there is a transition happening from traditional lending to the newer forms of lending. And also the fact that there is equity capital that is coming in large measure, which is absorbing some of this. So to some extent, the market could be factoring in a little bit of a derating, right? Now, what tends to happen is, if you're looking at these banks going back to their peak valuations, then you're probably being too optimistic. But I think if you are seeing them in the context that they've underperformed, there's a derating risk, and staying away from them, you could actually miss out. Because once the economy starts picking up a little bit more aggressively with loan growth coming through, it's going to be the traditional cycle of saying, hey, you're in a situation where loan growth is picking up, interest rates are probably firming up a little bit. You have margin upside, and that's when you will start seeing a valuation creep up. So I just say, it is a little transitory, this pain that you faced. It is something to think about more than you would in a conventional sense. But at this point in time, I still see it as much more of an opportunity than a structural trend where one should typically stay away. I think the other thing that you also need to keep in mind is that one, pure earnings from a reversion of provisions are going to be fairly supportive, and the sector is much cheaper than a lot of sectors in the market at this point in time. So we see it as an overweight. We see it as a space where you've missed so far, but everything is falling in place, and we would tend to believe that this is a sector that will do pretty well from here.
Okay, we'll leave it at that. Thank you so much for joining us today live on the market.